Good morning, ladies and gentlemen. My name is Christian Hermann. I'm Head of Investor Relations and M&A at Daimler Truck. I warmly welcome you to our first annual result conference. Thank you all very much for joining today. This is the first time we are presenting our business results as an independent listed company, so a very special day for us. Because the COVID-19 pandemic is still ongoing and safety is our priority, we decided to host this event digitally only. Moreover, we are hosting this event, the first part of this event, as a joint event for analysts, investors, as well as for media. This is why I'm very glad to have Jörg with me today.
Thank you, Christian, and good morning also from my side. My name is Jörg Hove. I'm the Head of Global Communications at Daimler Truck. Let me briefly tell you what you can expect today. First, our CEO, Martin Daum, and our CFO, Jochen Götz, will present our business results. This will take around about 45 minutes, and there will be a simultaneous translation into German. Afterwards, our executives will do 2 Q&A sessions, one for analysts and investors, and the other one for media representatives. Active participants in the Q&A calls have already received their personalized access data with their registration. Now let's start with welcoming our speakers, Martin Daum, our CEO, and Jochen Götz, our CFO. Martin and Jochen, the stage is yours.
Good morning and a warm welcome from me as well. Thank you all for joining us today. Ladies and gentlemen, in these traumatic weeks, it is impossible to focus strictly on business. The war in Ukraine started exactly 1 month ago, and every day I am shocked by the suffering it causes for so many people. And it's not just me, that is the overall sentiment at Daimler Truck. We therefore donated €1 million to the United Nations Children's Fund as an immediate measure, and we are providing trucks and buses for aid deliveries. Moreover, colleagues from various areas of our company set up a task force for humanitarian aid, and every day this task force receives countless offers of help. Our employees from all over the world want to join in, so we are just launching a global donation campaign. All employees can participate, and our company will then double the donated amount. This great solidarity with the people in Ukraine makes me once more proud of our entire Daimler Truck team. When we now turn to today's event, I'm very proud as well, because after 125 years as a business unit of the former Daimler AG, we are now an independent company. As of this week, we are also a proud member of the DAX. And today we are hosting our first annual results conference. So let's get started. At Daimler Truck, we work for all who keep the world moving. Trucks and buses are the backbone of our society and economy. Without them, the world would simply stand still. So we are proud of what we do, and we are equally proud to be an industry leader. We have strong brand and teams in all regions, in the Americas, in Europe, and in Asia. We have cutting-edge technologies in fuel efficiency, in safety, and in emission-free drivelines. And we have a rock-solid balance sheet. Going forward, we have clear strategic priorities and ambitions to create additional value for our customers and for our investors. Ambition number 1 is to lead sustainable transportation. To that end, we are developing battery electric as well as hydrogen-based vehicles because we are certain our industry will need both technologies. Ambition number 2 is profitability. We are fully dedicated to deliver benchmark profitability and a strong cash flow in all regions. To unlock our profit potential, we have a broad range of measures in place. So we have a clear plan going forward, and we consistently execute this plan. In 2021, we further accelerated sustainable transportation. We launched our Mercedes-Benz e-Actros a heavy-duty battery truck for regional distribution. Our e-trucks, Actros, hereby joined our light truck Fuso e-Canter, our school bus Julie, and our city bus e-Citaro, which are in serious production as well. So we already have an impressive portfolio of battery electric vehicles. In Germany, our e-Citaro accounts for almost half of the total market for fully electric city buses in 2021. In addition, we initiated several important partnerships in the past year. Our joint venture Cellcentric started in March and is now making fuel cells ready for mass productions. Our infrastructure partnerships in Europe and the US will install high-performance charging and refueling networks for battery and hydrogen-powered vehicles. One last point in that regard. As we increase our investment in zero-emission vehicles, we have to reduce or limit our investments in conventional vehicles and technologies wherever possible. We have therefore partnered with Cummins to outsource development and production of medium-duty engines. We are also executing our second strategic ambition, the ambition to unlock our profit potential. Consequently, we have further intensified our active portfolio management. We have introduced new vehicles in attractive markets, launching our new Western Star trucks in North America to further grow our position in the vocational segment, launching our Tour Rider, a Mercedes-Benz branded motor coach to address the expanding coach segment in North America. At the same time, we are streamlining our portfolio focused on the largest profit pools. At Mercedes-Benz, for example, we have significantly reduced the variety of vehicles while still fulfilling our customer needs. We lowered the number of base models from roughly 140 to 100, a reduction of 30%. This reduces our procurement, production, and even marketing complexity and costs. At Daimler Buses, we are concentrating on our core business of buses and chassis over 8 tons. We therefore sold our German-based minibus business as of January 1st, 2022. Next to that, we set ourselves ambitious targets for fixed cost, CapEx and R&D, as well as for the share of service revenue. And we consistently execute all that. First, fixed cost. Our ambition is to reduce our fixed cost by 15% by 2023 compared to 2019. In 2021, we already achieved a reduction of 12%. A strong contributor was Mercedes-Benz. Here we already achieved 50% of our aspiration to reduce personnel cost by 300 million by 2023 and to reduce non-personnel cost by 200 million by 2025. Second, we are aiming to reduce CapEx and R&D by 15% by 2025. We therefore fully focus on future return on capital, profit pools, as well as transformation targets. In 2021, we reduced our CapEx and R&D by 18%, meaning we even surpassed our ambition. That's because the reduction of diesel-related investments had a head start compared to the required ramp-up of zero-emission investments. Going forward, that means our aim to reduce CapEx and R&D by 15% remains still valid and ambitious. Third, our initiative to grow our services will help to translate customer relationships into recurring revenues and make us more resilient. It will help to make our business less cyclical and drive margins as well as return on capital employed. Of course, increasing our service revenue takes longer than reducing our costs. But we are on track here as well. In 2021, the services share of our revenue increased to 31%. Main driver was the after-sales business in North America. As you can see, we are in full execution mode regarding our profit potential, and we are very transparent about our progress. Let us now look at the market environment in 2021. In North America, 2021 was a very strong year for heavy-duty trucks until the semiconductor shortage hit in the third quarter. Due to these constraints, 2021 only ended at an average level, and that level does not reflect demand. Customer demand was significantly higher, and the market development was completely dependent on supply. In the Class 8 segment, we achieved a market share of 40%, matching our previous highs in 2016 and 2017. In the European region, the market for heavy-duty trucks increased by 19%. Despite that, the volume was still below pre-COVID levels. And much like in the US, the limiting factor was not demand, but supply. Without supply chain constraints, market volume would have been noticeably higher, and our sales as well. As for the worldwide environment, with the exception of China and Japan, all regions have recovered in the past year. But our most important regions are still below their historical averages. Now let's see how we translated that market environment into sales and orders. As for sales, we achieved a strong increase of 20% compared to 2020. Our sales growth could have been even stronger, but it was constrained by the global supply chain challenges mentioned before. We even accomplished an increase of 9% in the fourth quarter despite continuous disruptions and supply bottlenecks. This was a great team success, where the entire Daimler Truck team worked hard to deliver as many vehicles as possible to our customers. We continued production until the very end of the year and shipped our last trucks to customers on December 31st. With respect to orders, the past year was extremely strong. Incoming orders accounting to 590,000 units, an increase of 37%. This underlines our great product lineup. Our customers love our trucks and buses. In the fourth quarter, orders were lower than in the third quarter, but this had purely technical reasons. We were replanning our 2022 production schedule, and this limited our order intake. To round that up, a few insights at business segment level. In North America, our order backlog stays at historical high levels. Demand for all our products is high. For example, we see extremely strong interest in our vocational trucks, especially in our new Western Star models. Mercedes-Benz achieved a book-to-bill ratio for more than 150%, which underlines the success of our increased customer focus. In Asia, sales were 30% above prior year. Incoming orders even increased by more than 50%. Not included in our sales are the Chinese sales of our joint venture BFDA in the magnitude of 103,000 units. This is a 19% below prior year. At Daimler Buses, the important coach and tourism segment in Europe was still down due to COVID-19. The market in Latin America recovered from a low level. Now a quick deep dive in our zero-emission sales. In 2021, we sold more than 700 battery electric trucks and buses. That is more than triple our 2020 volume and a strong increase, so there is great momentum. The major limiting factor now is not the vehicle. Our battery vehicles are in serious production, meaning we can produce thousands of them. The limiting factors are the infrastructure and the framework for cost parity with conventional vehicles. All three factors need to be in place so that our customers can make zero-emission vehicles the backbone of their fleets. We, as Daimler Truck, are working closely with energy companies and policymakers. We all now need to join forces to move things forward. Next, let's look at the earnings we achieved in 2021. We finished the past year with an EBIT as booked of 3.4 billion euro. We achieved an EBIT adjusted of 2.6 billion euro and an adjusted return on sales of 6.1% and a free cash flow of 1.6 billion euro. Our earnings per share come to 2.85 euro. and our industrial liquidity amounts to 6 billion euro. Our environment is volatile, and in times of uncertainty, it definitely helps to be in a strong financial position. We already touched on many important factors that influence our results. Additional positive effects came from strong aftermarket business and the strong demand for used vehicles. Our new financial services segment also made a strong contribution to our bottom line. We did a great job ramping up the business. In contrast, the global supply chain challenges had severe negative effects. We sold a lot fewer vehicles than we could have sold. For the trucks and buses we did sell, we were facing significant constraint costs in our production processes, for example, where we had to rework lots of unfinished vehicles. In addition, prices for raw materials increased significantly due to our high order backlog. We could not adjust our pricing accordingly. This put pressure on our contribution margins. In sum, last year's environment was quite challenging. But despite these challenges, we still finished 2021 in line with our guidance. I am therefore very proud of what we as a global team accomplished. I would like to thank our entire team, and I know that many of you are tuning in today. Thanks a lot. 2021 was a lot of hard work, and you did a really great job. Now a quick deep dive on our return on sales. First, our return on sales of 6.1% is a great improvement compared to 2020 and is also above the pre-COVID year 2019. Trucks North America did not perform as strongly as in 2019, but this is due to the headwinds mentioned before, especially constraint cost and raw material increases. Trucks North America still is a benchmark for profit in North America. Mercedes-Benz achieved a significant improvement and would have been even more successful without the semiconductor shortages. Trucks Asia strongly improved as well and benefited from one-time effects in China. Daimler Buses was affected by COVID-19 but achieved important structural improvements, especially reducing fixed cost. Financial services are fully on track in ramping up the business. Bottom line is this: our measures are paying off. Our earnings are moving in the right direction. We are on track to unlock our true profit potential. We therefore can be proud of what we have already achieved. At the same time, we remain fully committed to go all the way to reach our 2025 margin ambitions. You know that we defined different scenarios depending on the environment. 2021 corresponds to our cloudy scenario, which means in such an environment, we want to be able to achieve a return on sales of 8 to 9%. So there is still a gap, but we have a clear plan how we aim to close it by 2025. And we will keep executing this plan. We will not loosen up here, not a bit. With that, I would like to hand over to Jochen. The floor is yours.
Thank you, Martin, and also a warm welcome from my side to our first independent Daimler Truck full-year disclosure. Martin already mentioned some of the key figures, but now let's have a closer look at our financial performance of the group and the segments in the financial year 2021, as well as the fourth quarter. Year over year, revenue for the group increased by more than 10% to 39.8 billion euro for the financial year 2021. Adjusted for FX, revenue increased by 13%. EBIT reported in 2021 increased significantly from 0.5 billion to 3.4 billion euro, and on an adjusted basis from 0.7 billion to 2.6 billion euro. Free cash flow of the industrial business decreased from 1.8 billion in 2020 to 1.6 billion in 2021. The reduction by 200 million is mainly attributed to the global impact of the semiconductor bottlenecks and the elevated inventory levels at the year-end. Net industrial liquidity is strong and stood at 6 billion at the end of 2021. Next, a closer look at our industrial business performance in 2021. In 2021, we have seen a strong recovery in core heavy-duty markets together with improved net pricing and positive contributions from after-sales as well from our used truck business. These factors led to an increase of revenue to 38.6 billion. Despite the headwinds from raw material prices and supply-constrained inefficiencies, we could translate this into a solid growth of EBIT adjusted and a corresponding return on sales adjusted of 6.1% versus 1.9% in 2020. Including the adjusted one-time effects mainly from cellcentric, return on sales of the industrial business stood at 8.2%. Overall adjusted items were at 0.8 billion, thereof M&A 0.9 billion, as mentioned, mainly cellcentric, and restructuring of minus 0.1 billion. Our highest priority in the fourth quarter was to fulfill our customer demand as well as possible. We continued production until the very last day of the year and accepted higher cost and inefficiency to supply as many vehicles as possible to our customers who were eagerly waiting for them. Therefore, the financial result in the fourth quarter was hit hard by supply chain-related constraint costs and related inefficiency in our production. But we deliberately prioritized long-term customer relationship over short-term optimization. However, even with those measures, we were not able to fulfill the total customer demand. In addition, raw material prices have not yet been offset by the implemented price increases, and a non-recurring warranty issue in the United States both had a negative impact. Hence, Q4 adjusted margin came in at only 4.7% versus 5.5% in the previous year's quarter. Now, let's take a closer look at the individual EBIT drivers for the full year 2021 compared with 2020. Main driver of the 2021 results are volume, mix, and net pricing. A total positive contribution of 2.1 billion euro year over year. Volume and mix, pricing, and after-sales and used business all contributed to this increase. Small negative effects related to FX, bit less, half of it coming from the translation side, mainly coming from the US dollar and the Japanese yen. Regarding our industrial performance, 2021 was burdened by a high triple-digit raw material cost increase and constraint costs. Positive impacts from lower burden of warranty costs compared to 2020 could not offset. The raw material cost increase has not been fully covered by pricing in 2021. Considering the recovery of the markets and operations from the COVID-19 pandemic, I'm proud of the fixed cost discipline we achieved in 2021. As described before, we are on a good track to achieve our ambitions. In the others line, we had a positive one-time valuation effect, in particular coming from our Chinese joint venture BFDA in our Truck Asia segment, as already communicated in our Q3 disclosure. Our financial services segment supported group performance with a 0.2 billion EBIT contribution with a positive effect from significantly lower cost of credit, especially in North America. This leads to an adjusted group EBIT of 2.6 billion euro. Including the adjustments for restructuring and M&A, EBIT reported came in at 3.4 billion euro. Now, a closer look at our segments. At Trucks North America, we significantly increased our 2021 top line due to considerably increased new vehicle sales, strong pricing, and a stronger aftermarket and used truck business. The overall effect counts for 0.9 billion euro. Negative FX effect and lower industrial performance, mainly driven by higher raw material costs and increased variable costs, reduced this positive effect by more than half. Fixed costs was on the low level of 2020, despite the unwinding of COVID benefits. Return on sales adjusted for the full year amounted to the strong 9.2%, whereas the 7.3% in 2020. In comparison to the prior year, the fourth quarter was negatively impacted by extraordinary warranty costs to a product recall accounted for in Q4. This recall effect alone accounts for approximately 2 percentage point return on sales. Additional headwinds for material costs, supply constraints costs driven by inefficiency in production, and on the logistics side, mainly driven by the reduction on half of the offline inventory of almost 20,000 units we had at the end of the third quarter. Despite all these negative effects, Q4 adjusted margin was still at 5.4% return on sales. Mercedes-Benz Truck is constantly improving. Full year return on sales adjusted increased to 4.8% from -1.7% in 2020. Mercedes-Benz showed a strong top-line increase due to a strong recovery in sales, despite significant supply constraints. As in the United States, the supply situation, especially in the second half of the year, was the limiting factor for our sales volume. Both the after-sales business as well as the restructured used truck business contributed positively compared in 2020. Similar to Trucks North America, during the course of the year, we experienced a significant increase in raw material costs. We were not able to fully offset this headwind in 2021 because price increases only come into effect with a certain time delay. We continued with our strict cost control and the execution of the initiated restructuring initiatives. As mentioned before, Mercedes-Benz significantly contributed to the fixed cost improvement versus 2019. Remember, we had a temporary cost saving from the COVID situation in 2020. Despite the fact that we don't have this COVID-related cost benefits anymore, we could offset this with structural fixed cost reduction measures. In Brazil, we achieved our break-even as planned. Most important for us is the quarterly track record in 2021 with constantly lower fixed costs quarter by quarter. This is a clear proof point that we are reducing the gap to our benchmark and delivering on our financial ambitions. ROS adjusted in Q4 with 5.4% was even above the 4.8% for the full year 2021, despite all the headwinds. This underlines that we are on the right track with our margin improvement measures. At Trucks Asia, we achieved significant top-line increase in 2021 due to the market recovery, including a pre-buy effect in Indonesia. Although we sold fewer trucks in 2021 compared to 2019, we were able to more than double return on sales adjusted to 7.2% versus 2.3% in 2019. Please be aware that within the 7.2%, a one-time effect of our Chinese joint venture BFDA is included. This was booked in Q3 and has a positive impact of approximately 2 percentage points on the return on sales for the full year. The strict fixed cost control paid off at Trucks Asia and contributed positively to the development. On a quarterly view, Q4 was very strong with a return on sales adjusted of 6.9%, mainly supported by the mentioned pre-buy effect in Indonesia. At Daimler Buses, we saw consistent business development in 2021. City markets are stable, whereas the coach segment in Europe is still very weak. In Latin America, we saw a market recovery coming from a low level. All this led to a decline in revenue, mainly due to negative volume and mix effects. As expected, return on sales adjusted for the full year 2021 was negative at 2.4%. Given the market environment, the significant higher raw material costs could not be compensated via price increases. Restructuring activities and strict cost management resulted in further fixed cost reduction, foundational work to strengthen the division for when the volumes recover. With the cost structure of 2021, we would have achieved a benchmark margin if we would have been in a 2019 sales environment last year. Q4 2021 showed a slight improvement in after-sales, but was mainly depressed by even lower volume versus last year and negative mix effects. Also in the last quarter of 2021, return on sales adjusted was negative with -2.1% versus 3.6% in the previous year's fourth quarter. Putting the pieces together to the industrial business performance, you clearly can see that all three truck segments contributed positively to the development. Bus faced a tough environment in 2021 and, as just mentioned, made very good progress on the cost side despite the negative year-over-year performance. We are very proud on the restructuring progress at Mercedes-Benz, contributing 1 billion of the total EBIT improvement. Reconciliation, which is part of our industrial business, mainly contains costs for autonomous and the fuel cell joint venture. All in all, this leads to an EBIT adjusted for the industrial business of 2.4 billion euro, with a return on sales adjusted of 6.1%. Including the adjustments, which the major effect of 1.2 billion euro resulting from establishing the fuel cell joint venture cellcentric, EBIT reported amounted to 3.2 billion euros, with a return on sales of 8.2%. Looking at financial services, new business was slightly up, despite the lower penetration rate, mainly due to the mega fleet customer effect in the United States. Contract volume increased by 6% to 16.9 billion by the end of 2021, mainly driven by positive FX effects in the United States and Canada compared with 2020. EBIT adjusted in 2021 increased significantly to 0.2 billion euro, leading to an adjusted return on equity of 12.4%. The main drivers here on the positive side were the higher interest margin, mainly in North America, and the significantly lower cost of credit in North America after the COVID-19 pandemic. Detailed walks and further information on the financial performance of each segment are included in the appendix to this presentation, as well in our fact book. On cash flow, supply chain constraints caused higher inventories, translating in a total negative effect from an increase of working capital of 356 million. But keep in mind that behind every vehicle sitting in our inventory, there is a customer urgently waiting for the trucks to be delivered. The net investment bucket includes a positive effect of 0.5 billion euro from financial investments, mainly driven by our fuel cell joint venture cellcentric. On the positive side, despite executing on our product roadmap by applying strict investment discipline, depreciation and amortization of 1.11 billion euro once again exceeded net investments in PP&E and in intangible assets. In the provision and others category, we saw a negative effect of 1.2 billion euro, mainly from the elimination of the profit impact from cellcentric. This leads to a CFBIT of the industrial business of 2.2 billion euro and adjusted for restructuring measures and M&A transactions to a CFBIT adjusted in the industrial business of 1.9 billion euro. On the walk to free cash flow, cash taxes are at -524 million euros. Free cash flow of the industrial business without the adjustments for M&A transactions and restructuring measures came in at 1.6 billion euro. This leaves us with 1.3 billion euro free cash flow adjusted for the industrial business. Our balance sheet is rock solid. Our net industrial liquidity rose to 6 billion euro. The increase was driven by the industrial free cash flow of 1.6 billion and impacts coming from the spin-off. This effect mainly consists of received capital injections from former Daimler AG of 5.4 billion and payments to Daimler AG of 2.8 billion for the subsequent acquisition of entities transferred to the truck business. Before giving you a view on the outlook for 2022, please allow me for the following remark. Given the global situation with the COVID-19 pandemic still present, supply bottlenecks in the markets, and especially with the ongoing war in Ukraine, currently uncertainty is very high. our operational exposure in Russia and Ukraine is relatively low, roughly 1% of our global total sales. Unlike others, we are currently not directly affected by additional supply chain issues caused by the war or the sanctions. Taking a cautious approach, we will, from today's point of view, impair all our Russian-related assets in Q1 2022. This is a one-time effect of approximately 200 million euro. We will include this as an adjusted item in EBIT Q1 2022. The currently foreseeable operational effects, such as the halted Russia business, as well as the currently incurred higher raw material and energy costs, are included in the guidance for 2022. We keep track of our targets for 2022 and monitor the further development very closely. We are also consequently working on our self-help measures. Given that, and based on the current information, we currently feel confident to achieve our targets for 2022. All guidance is made with the following assumption. We currently assume that the economic conditions in our most important markets continue to normalize, and that neither the COVID-19 pandemic nor the war in Ukraine will have a negative impact on the general market development. Despite strong demand, bottlenecks in the semiconductor industry and ongoing supply constraints will continue to impact sales, mainly in the first half. So now let's have a look at the market guidance for the full year 2022. Based on the expected global economic development, we anticipate for the heavy-duty truck market in North America a range of 255 to 295,000 units, the European heavy-duty truck market at a range of 240 to 280,000 units. On the group guidance, we expect revenues in the range of 45.5 to 47.5 billion euro. EBIT adjusted is expected to significantly increase in 2022 compared to 2021, whereas EBIT reported should slightly decrease. As a reminder, significant increase means more than 15%, and a slight decrease means between -5% and -15%. We expect investments in PP&E and R&D costs to increase slightly, coming from a low level in 2021. As already mentioned, the increase versus 2021 is driven by the increasing investments in new technology. Our target of a reduction by 15% versus 2019 remains in effect. Looking at the guidance of our industrial business, we expect unit sales in the range of 500 to 520,000 units and revenues in the range of 44 to 46 billion euro. Based on the currently available information, we are confident we will achieve a return on sales adjusted within a range of 7 to 9%. With price increases affected starting in Q2 and significant shortages in semiconductors, we expect the first quarter to be the weakest quarter. That means below the guided full year 2022 performance. Free cash flow reported is expected on prior year level, with the first quarter still being impacted by higher inventories driven by the chip shortage. So what's the outlook on the segment level? For Trucks North America, we expect unit sales in a range of 175 to 190,000 units and return on sales adjusted in a range of 10 to 12%. For the full year, we expect further significant improvement at Mercedes-Benz Trucks, with unit sales in a range of 155 to 175,000 units and a return on sales adjusted in a range of 6 to 8%. For Trucks Asia, we expect unit sales in a range of 140 to 160,000 units and ROS adjusted in a range of 3 to 5. Keep in mind that 2021 included a 2 percentage point one-time effect from the impairment reversal of BFDA. For Daimler buses, we expect unit sales in a range of 20 to 25,000 units and was adjusted at least at break-even. For financial services, we expect a new business volume of 8 to 9 billion euro and an adjusted return on equity between 5 and 7%. So much from my side for the financial performance for the full year 2021, and back to Martin for the strategic outlook.
Thank you, Jochen. Let us now look at our strategic priorities in the current year. What is on our agenda regarding profitability? First, we will, and we have to, manage the environment. We expect an overall strong global market demand, and we will take advantage of that with our strong products and our strong sales team. At the same time, we continue to fight our headwinds. And sometimes I have the feeling the winds are blowing even harder this year. As for supply chain and inflationary challenges, Jochen already touched on our pricing adjustments to support our contribution margins. Regarding the war in Ukraine, we of course will monitor the development very closely. Second, we will further increase our resilience. We will continue our strict cost control, and we will continue to grow our services, our aftermarket business, for example. We will also continue to build up our benchmark financial services on a global scale. Our other strategic priority, of course, is sustainable transportation. In the coming months, we will further broaden our portfolio of battery electric vehicles. We will launch our heavy-duty truck Freightliner e-Cascadia with a range of up to 400 kilometers. We will launch our Mercedes-Benz e-Econic, a refuse collection specialist. And we will introduce the next generation of our light truck Fuso e-Canter. Our e-Canter is a real pioneer of an emission-free transportation. We launched the first model back in 2017. So in the course of the year, we will launch 3 new battery trucks on 3 continents. Plus, we will introduce an electric bus chassis in Latin America with a range of up to 250 kilometers. And we will intensify our testing of our hydrogen-powered trucks on public roads. Parallel to accelerating zero-emission transportation, we are also accelerating autonomous trucking. As we speak, we are delivering Class 8 autonomous-ready Freightliner Cascadia trucks with redundant functions to our partner Waymo. These trucks are equipped with a second set of critical systems like steering and braking to ensure maximum safety. And as we speak, we are also intensifying testing autonomous trucks together with our partner Torc Robotics. We do so on public roads in several US states. We look forward to giving you a comprehensive update on autonomous trucking in the second quarter of this year. Let me conclude by strengthening this point. We want to get a lot done this year and in the years to come. And I'm very confident we will succeed. Why? Because we already made a big leap forward in 2021, as our annual results clearly show. And because I know what we're doing right now to make 2022 an even bigger and higher success, despite the headwinds we are facing. And because at Daimler Trucks we have a spirit that I'm really proud of. We will live and breathe sustainability. We have already established an ESG framework. This will be an important pillar of how we run our company. We have a culture of trust and entrepreneurship where people feel they can truly make a difference. And we have a team that wants to show the world what Daimler Truck is capable of doing as an independent company. All of that will be a great enabler going forward. So we are very excited about our road ahead. Thank you. We will now have a short break before we continue with our Q&A sessions.